Hello and welcome. Today, we're going to break down one of the simplest, but honestly, one of the most powerful strategies you can have in your investing toolkit, dollar cost averaging.
So let me ask you this. Have you ever been staring at a stock chart, watching it go up and down, and just feel completely paralyzed? You're thinking, should I jump in now, or what if I wait and it drops? Yeah, if that sounds familiar, you are definitely in the right place. That pressure is real, and you are not alone.
All right, before we dive deep, I have to say this. Everything we talk about today is for educational purposes only. It's not financial advice. So please, make sure you do your own research or chat with a professional who knows your specific situation.
Okay, with that out of the way, let's talk about a huge challenge that so many investors run into. I call it the market timing trap. It sounds so simple on the surface, but this is where a lot of us get tripped up.
You know the old saying, right? Buy low, sell high. Easy, except it's not. Trying to predict the absolute bottom of the market? Man, that's like trying to catch a falling knife. It's nearly impossible, even for the experts, and it usually just leads to you doing nothing at all.
So if trying to be perfect is the trap, then what's the way out? Well, it's a wonderfully simple strategy that's all about one thing, consistency. And it's called dollar cost averaging, or DCA for short.
So what is it? What is DCA? At its heart, it just means you're investing a fixed amount of money on a regular schedule. Could be monthly, could be weekly. And here's the key. You do it no matter what the market is doing. Up, down, sideways, it doesn't matter. You stick to the plan. And it really just boils down to 3 super easy steps. 1, pick a fixed amount of money that you're cool with investing. 2, set a regular schedule, like the first of every month. And 3, you just do it consistently. You set it, you forget it, and you let the system do the heavy lifting.
All right, so that's the theory. But how does this actually play out in the real world? Let's run through a quick example to really see it in action.
Let's say you've decided you're going to invest $500 every single month. That $500, that's your constant. It never changes. The market, on the other hand, well, that's going to do what it's going to do.
And here's where the magic really starts to happen. When the market is down, when prices are low, your $500 is actually more powerful. If a share costs, say, $10 this month, your money buys you 50 shares. You're basically getting a discount without even trying.
But what about the flip side? What if next month the market's flying high and that same share now costs $20? Well, your $500 now buys you 25 shares. See what happened? The system automatically stops you from buying too much when prices are high.
So let's look at the numbers after just 2 months. You've put in $1,000 total, and you now own 75 shares. This means your average cost for each share works out to about $13.33. You didn't time anything, but you naturally bought more when prices were low and fewer when they were high. It all averages out. And when you zoom out over months and years, you're not trying to hit home runs by buying at the absolute bottom. Instead, you're buying at an average price over time, which really smooths out those crazy market swings. And you know what the best part is? It takes away all the stress of trying to make that one perfect call.
Now, let's really put this into focus. Let's compare the mindset of someone using DCA versus someone who's still stuck trying to time the market perfectly. Believe me, the difference is like night and day. You've got the DCA investor over here. They're calm, they're disciplined, they're always in the market, benefiting from all of its moves. Then, you've got the market timer over there. They're anxious, they're second-guessing everything, and worst of all, they're probably sitting on the sidelines watching the market go up without them. And this really gets to the core of why this strategy is just so powerful. It's not just a numbers game, you know? It's a behavioral strategy. It's all about building the power of discipline into your financial habits. So let's just run through those benefits one more time. It massively cuts down on making emotional decisions with your money. It forces you to be disciplined. It takes all the guesswork out of the equation. And most importantly, it makes sure you're always participating. You're always giving your money a chance to grow. Now, if you're interested in the whole FIRE movement, that's financial independence, retire early, this should sound really familiar. I mean, the entire philosophy is built on this exact idea: consistent, long-term saving and investing. DCA isn't just a strategy, it's pretty much the FIRE mindset in action.
So as we start to wrap this up, if there's only one thing you remember from our chat today, please let it be this. This is the big idea.
Building wealth for the long haul, it's not about being a genius who can predict the future. It's about discipline. It's about showing up month in and month out, and just sticking to the plan. Over time, consistency will be trying to be perfect almost every single time.
There's a famous saying in investing that just sums us all up perfectly. It's not about timing the market, It's about your time in the market. And dollar cost averaging is one of the best ways I know to make sure you do exactly that. Thanks so much for joining me today.